I'm David Bank, and from Impact Alpha, this is an Agents of Impact podcast.
What I found is that many owners on the private side are leaving money on the table, and that's because they may not have the sophistication or the relationships to be able to underwrite these types of public-private partnerships or incentives, and they need, investors need a partner who understands that, and that's where primary housing comes in, right?
That's Ty Thomas of Primary Housing, an emerging fund manager focused on NOAA, naturally occurring affordable housing. Ty is looking to preserve and improve the kind of aging, unrestricted, market rate apartments that house teachers, firefighters, and other essential workers. Primary Housing has been an active and early user of ImpactAlpha Edge, ImpactAlpha's premium databases and other investment tools for fund managers and other agents of impact. I think you'll enjoy our conversation. Ty Thomas, welcome to the podcast.
Hey, it's great to be here, David. I've been looking forward to this for a long time.
Great. Us too. And Ty, what I want to do is sort of take you through the journey, which I think that some of our listeners would be interested in, of becoming essentially a financial entrepreneur, but more to the point, an affordable housing entrepreneur, an affordable housing finance entrepreneur. And so maybe just take us back to the beginning. You were a freshly minted MBA out of Columbia, and you got thrown into the deep end of the commercial real estate market. Tell us what happened next.
Great, David. So I've always been on the institutional side of real estate. So after Columbia Business School, I joined Nuveen Real Estate, where I focused on affordable housing and public-private partnerships. What I kept seeing was a disconnect between capital and the need. In particular, a lot of institutional capital was focused either on the luxury development side of the market or highly subsidized affordable housing. However, there was a large middle segment of the market that wasn't being addressed. And that's really what led to the insight for primary housing. The idea was to bring institutional discipline and affordable housing tools to workforce housing preservation. So, what we do is we buy and we improve existing assets that serve middle income renters, all the while maintaining affordability and generating strong returns.
I love this acronym NOAA, naturally occurring affordable housing. That's a lot of units out there that just, like you say, workforce housing, like that means firefighters, teachers, regular folks, doing essential jobs in their communities, being able to actually afford housing in those communities. Tell us how that market works.
Yeah. So to your point, the way traditional affordable housing works is maybe you look at it in three buckets for your audience, right? You think about properties that were built with low income housing tax credits, properties that have some type of subsidy attached to them, usually as project based Section 8 or vouchers. And then there's another segment called NOAA, naturally occurring affordable housing. And the way I think about NOAA, the easiest way to think about it is it's an unrestricted asset. It's a market rate asset. There's no sort of affordability attached to it currently, but it's affordable at for a certain percentage of AMI, usually 80% of AMI or below. And while I was in Nuveen, I saw that was an interesting opportunity and to work and acquire those types of assets. These were usually aging assets that were in the path of growth and development, and usually they were at risk of either being converted into market rate apartments where rents were going to be jacked up, residents were going to be displaced, or maybe they were just dilapidated and they would deteriorate. And so that was one side of the market. But to your point, there were millions of middle income households that needed access to these units. And so I thought there has to be an opportunity here. And lo and behold, there was. So municipalities, wasn't just me who was paying attention to it. Municipalities across different states realized that affordability for the middle class was becoming a really important issue. And so this NOAA stock was going to be important to preserve and create more of it. And so that's what led to the idea for primary housing.
Yeah, so preserve is the key word, I think, there, because I think there's a lot of attention focused on how to build more housing but what you're pointing to is actually probably a much bigger opportunity and a much more realistic or within grasp kind of opportunity, which is these houses are already built. They have to get updated and maintained, as you say, but then they also have to be maintained at affordable rents, because isn't there a market pressure for all those building owners to sell out, and then you turn those things into luxury condos of some sort, and then they're priced out of the market.
I'm glad you said that. That's a very important point. So part of the strategy that have identified, or part of the strategy is, again, you acquire these assets usually below replacement cost. You make targeted improvements to capex, and then you also, part of our business strategy is, in the upside case, we're going to work with local municipalities on certain financing incentives, whether it be tax abatements or below market financing, and that's really something you underwrite in as an upside. You're not dependent on it, but municipalities have realized that, again, this is an important issue, and so they're incentivizing private owners, to preserve these assets.
And then you, just so I understand it, then if you agree, get those kind of incentives and those tax abatements and whatnot, then you agree to some kind of rent restrictions over the course of time.
Exactly, exactly. So usually, you self-restrict a percentage of the units at a certain percentage of AMI, and in exchange, you're able to work with the local municipality or the state on some type of incentive that, again, to your point, preserves affordability for residents, but also provides returns for investors.
Okay, and so just square the circle now. You've got rent restrictions on, so you're making these things affordable. Therefore, you're not, maybe most folks might think, not necessarily maximizing your rent take. How do you make that an investable proposition? How do you attract your investors to those kinds of deals?
Absolutely. So to your point, you want to think thoughtfully about comparing the alpha that you might get from taking an existing asset, implementing a value add strategy, raising rents. You compare that return to the return you would get from maybe an NOI enhancement that comes from a tax abatement, or an NOI enhancement, or your return, your yield that might the increasing yield that might come from the lower cost of debt that you were able to get because you self-restricted these units and made them affordable. So typically what we would do is we compare the return from a value add asset to an affordable execution strategy, and we show our investors. And what we've seen is that usually there's a 150 to 200 basis point lift from the affordable execution, which typically outweighs the value add strategy, which allows us to gives us comfort, and gives our investors comfort that we're able to execute on this strategy, all the while maintaining affordability.
Let's just underline that for a moment. You're saying that the affordable option actually is the better investment than the luxury option, and so I think folks should just make sure to bookmark that point, and remember that when they hear about affordable housing, it's actually can be a better investment.
Absolutely. And one of the misconceptions about the space is that affordable workforce housing means lower returns. And that's not the case, right? You have institutional capital that's chasing higher yields, or stable income, and affordable housing and workforce housing has shown that it's a durable, risk adjusted, provides a strong, durable, risk adjusted return. And what I found is that many owners on the private side are leaving money on the table. And that's because they may not have the sophistication or the relationships to be able to underwrite these types of public private partnerships or incentives. And investors need a partner who understands that. And that's where primary housing comes in, right? We spent my career working with working across public private partnerships, understanding how to structure these different tax abatement strategies or below market financing strategies, and understanding how to bring those to fruition for our partners.
All right. Well, this brings us back to the story of primary housing, and to your story. So you've got the institutional experience, you've done the big deals, you want to set out on your own. How do you get going?
Yeah. So, primary housing launched last year at the end of 2025. We've already built a pipeline of acquisition opportunities in our target markets. We've identified roughly $20 billion of, just to give you more context about the strategy. In our target markets alone, there's roughly $20 billion of pipeline activity around California, Tennessee, and North Carolina.
Oh, that's interesting, Ty. Those markets. Why those three?
So those three markets are interesting because there's lack of supply, growing demand, and local municipal engagement around preserving or creating affordability for middle income renters in those markets. So that's why we chose, Tennessee, California, and North Carolina.
Well, California, biggest in everything, most, most expensive, biggest shortage, most homeless. But I imagine that that's quite a different market than Tennessee and North Carolina.
What's funny is you would think that, but I'll start with the first part of that question. But California needs roughly 1 million units for specific. California is short roughly 1 million housing units specifically for that 60 to 80% AMI cohort. Tennessee and North Carolina, the demand isn't in the millions. Tennessee is short roughly 40,000 units, but it's still an acute need in the regulatory environment. But that said, there's municipal engagement in each of those states that makes it an attractive opportunity for us and attractive for us to tell it. It makes it easier for us to tell the impact story as well as the return story for our investors because there's existing frameworks in place for things like you know tax abatements or below market financing. So that's why we chose those markets. So they're certainly far away from each other geographically, but I think structurally from a legislation standpoint, they're more similar than apart.
And so you've got a pipeline and you've got a thesis. Do you have investors?
Yeah, yeah. So we've identified a target list of investors that we believe are aligned with our values and our mission. So that was the key thing. We had to get those investors online and seek impact oriented investors who also knew that doing good doesn't mean you have to sacrifice returns. So we've identified a similar pipeline of impact oriented investors who were looking to institutional investors, I should say, or philanthropic style investors that we're looking to partner with and bring on board.
So you'd be considered in the field what I think folks think of as an emerging manager, perhaps even a first time manager, even though you do have the experience. That's one of the things that sometimes the investors overlook is the earlier chops that you might gain from being inside a big institution. But in any event, in the fund management world, you're probably considered a emerging manager or first time manager. How does that affect you?
No, great. I like that question. To your point, usually what we found is that emerging managers are not emerging in the way you would think they are. Emerging managers typically might have, $1 billion worth of assets under management, or maybe they're on their second or third fund. And so in the emerging manager space, on the institutional side, usually, it's a founding team with call it $1 billion or maybe $500 million of assets or more. Now, at the municipal level, on the city and state and local level, when you're engaging in public-private partnerships, the definition of an emerging manager is a little bit different. It's not as the threshold isn't as large, and so we've been able to work with certain cities like San Diego and become identified as an emerging manager or in this case an emerging developer, which allows us to become eligible to co-GP with larger developers on and compete for certain funding opportunities with the city of San Diego. So we certainly have gone down that route of looking for GP stakes investors who would identify us as an emerging manager. I don't think that's right for us now. But what I have identified is what we're focused on the next 12 to 14 months is continuing to build out those relationships with local municipalities where we're able to get access to certain funding sources that either make a development possible, a mixed income development, or that make actually an acquisition opportunity that fits our strategy, our middle income strategy, feasible. And the reason why it works, why established developers like it, is because usually they don't really have some of these established developers don't have a pipeline of acquisition opportunities. They're focused on pursuing tax credits or development deals with tax credits, et cetera. But they're starting to think about middle income and preservation as an opportunity. And when you're able to work and get access to different funding sources with a partner like myself, it makes it an attractive opportunity for them, and it's a win-win for all.
So roll up your sleeves, get some deals done, get some properties and assets working, prove the thesis, and then you can roll that up into a fund or any number of other kind of vehicles that become investable by some of the partners you've identified.
Exactly. And so how we've structured the way we've structured ourselves is as a programmatic JV partner for workforce and affordable housing acquisitions, which, what makes that interesting is why we think about the exit opportunities in a couple different ways. Usually we're going to hold for 5 to 10 years. We can refinance the asset. We can sell to a like-minded institutional borrower or a buyer that's looking for scale in certain MSAs and quality assets. And then we can also exit via a sale of our GP interest or our stake in that asset, or contributed to a fund, as you mentioned.
Let's just get personal for a moment and just tell us, why this path for you, and what makes this a meaningful line of work for yourself.
David, when I first graduated many years ago, when I first moved to New York City, I just graduated, and a friend told me about a building in Harlem where it was brand new construction, had an elevator, and the rent was only $1,300 a month. I couldn't believe it. And because I had just graduated and was starting my first job, I actually qualified for it. And you go through the red tape. It took 6 months to get in, and I thought to myself, wait, hold up, this has to be something's wrong here. But I ended up finding out later on that building was built with 9% tax credits. It was an affordable housing building, and I stayed in there, until for years, and it was an incredible experience to be able to live in a brand new building in New York City. And I said to myself, all right, I had to find
You
out
get
and
an
learn
apartment like
more.
that in New York, you don't leave it.
Yeah, you don't leave it. And I foolishly left, but it was great. It was good because I was able to turn that unit was able to turn and now house a new family and create stability and economic opportunity, for the next person. And so I thought, hey, if I get a chance to do something like this, I want to do it. And so that's what led to the inspiration to pursue affordable housing as a strategy. But then what led to, I thought, hey, where else can I add impact? And thought, hey, well, look, there's other middle income households out there that don't qualify for affordable housing, but I could help them. And so, that's where the strategy came about where, hey, let's try to find other assets that aren't restricted, but we could self-restrict them and work with an institutional business plan as well as public-private partnership, structure a public-private partnership and create, housing for more folks.
As this housing issue becomes just more and more central, and affordability, broadly speaking, is on everybody's minds. Um, we're hearing of folks who are seeing this opportunity as you are. Who are some of the people in the field that you've looked to either as direct mentors or just as inspirations out there? Who you think are doing well in this whole question of kind of preserving housing, and in particular, I suppose this NOAA opportunity that you're targeting. Who do you like out there?
Yeah, I love that question. I think you guys may have alluded to some of them on your podcast. You may even have some guests on there. I think Vistria Capital and Avanath, as some people say. I think they're doing a great job of not just preserving and creating deeply affordable housing, but also, getting some exposure on the NOAA side, or workforce housing preservation. I think they both do a great job. And in many cases, I think Vistria also, it's not just Vistria also partners with local operators and creates opportunities for emerging managers more on the institutional side to grow and scale their platform. So, sort of a double a double benefit all across the board.
Well, Ty, we'll be watching as Primary becomes the new Avanath, or the new Vistria, and we hope you come back and tell us how the journey is going. Thank you so much for joining us.
Thank you, David.
That's going to do it for this Agents of Impact podcast. Big thanks to Ty Thomas, to our producer Isaac Silk, to the whole team at Impact Alpha, and to all of you, Agents of Impact. with deep gratitude for all that you do.